This is the Nichols Patrick Current Federal Tax Developments for the week of August the 8th, 2016. Current Federal Tax Developments is brought to you, as always, by Nichols Patrick CPA Incorporated and your state society of CPAs. And this week, we're going to be looking at a few interesting things here. Basically, this week it's titled The IRS Strikes Back. The IRS has two places where they're going to come back at us on a couple of different issues, so we'll take a look at those going up. This is brought to you each week, as always, by us here at Nichols Patrick and by your state society of CPAs. Now, some of the cases we're going to look at this week. First case we're going to look at the fact that the AICPA had its turn this week to lose on a case involving the IRS's voluntary preparer licensing structure. An accountant who lost his job didn't lose his deduction for an MBA degree he received during the time he was unemployed. We'll talk about how the IRS challenged that and how they lost the challenge in that case. The IRS also threw in the towel this week on the issue of whether or not the home mortgage interest deduction for an unmarried couple is a per taxpayer or per residence limitation. The IRS is now going to go with the per taxpayer limitation. We had the issue of a problem for a bankruptcy case where the taxpayer discovered that even though the bankruptcy estate was responsible for the income taxes that were due on the income in question, he was responsible for the self-employment tax on that income, even though the bankruptcy estate had the full right to the income. The IRS also this week issued new proposed regulations to attempt to bring back to life Section 2704, make it useful for them in attacking various estate planning structures. We're going to talk about how those rules would apply and some of the dangers those rules provide. And the IRS this week kicked the can down the road on the question of the new partnership audit regime, because the IRS decided this week that what we're going to end up doing is this early election, we'll talk about the fact the IRS said the early election to use the new rules, well, you'll make that decision when you finally get a notice of exam from the service. So effectively, we'll talk about that coming out this week. Now, coming up for us now is we're going to have a few courses, or I'm going to have a few courses as we go along here. And one coming up for me here is going to be a week. In Washington Society, I'll be doing a webcast that'll deal with preparing Form 1041. And this is going to look at all kinds of issues related to trusts and estates. We're going to consider the Washington Principal and Income Act issues and take a look at some of the state tax traps that may exist. The Principal and Income Act is obviously a little bit different in every state. And while most states are very similar, and we'll talk about the uniform service, we're going to talk about in that case specifically any necessary Washington quirks. We'll look at the recently released drafts of the Form 1041 for 2016. We're going to use those as our point of reference. And if you want to sign up for this course, which will be webcast, you can find the sign up at wscpa.org/CPE. Take a look for the course on August the 15th. Also coming up, I'll be going out to Albuquerque, New Mexico at the end of the month of August. And on the 24th, I'll be doing a course for construction contractors with tax and accounting considerations. This particular course is a 50-50, shall we say, tax and accounting course. One of the few times that I go ahead and I do some accounting CPE at the same time as tax. And then on the 25th, I'm going to do a course on corporate taxation. We're going to look at the provisions that apply to corporations, whether you are a C Corp or an S Corp. We're looking at the C Corp, what we'll call these subchapter C provisions, which, by the way, if you weren't aware, they apply to both C and S Corps unless they are either specifically overridden by an S Corp provision or are clearly not consistent with how S Corps are treated. So it's really good to go back and take a look at things like corporate formation, liquidations, reorganizations, because even with an S Corp, those issues are still of interest. And if you're going to be in Albuquerque on the 24th and 25th, you can register for that at mscpa.org/CPE. Go on the web. We're going to be available for you those days. Now let's go ahead and start taking a look at our developments for this week. And in the first case we're going to look at is a case that's been around the block a few times. This is the American Institute of Certified Public Accountants versus the IRS. And this is number 1:14CV01190 from the U.S. District Court of the District of Columbia, issued on August the 5th. This case has been bouncing around a few times. What it deals with is the AICPA's challenge to the IRS's voluntary preparer licensing program. The IRS basically had proposed remember, at one point they were going to mandate all preparers had to be licensed by the service. The district court had knocked that down in the Loving case. But in a Loving case opinion, the District Court for District of Columbia had suggested that a voluntary program might be okay. So the IRS established a voluntary program. The AICPA objected to that program, claiming that it would cause confusion for consumers, among other things. And the same, unfortunately for the AICPA, it got in front of the same judge that heard Loving and who had suggested that they should consider a voluntary program. That judge threw it out for the AICPA not having standing. AICPA appealed. On appeal, the Court of Appeals said to the essentially that no, the AICPA had standing under the argument that it could create a dilution of the market that could cause problems for CPAs in terms of competition. So now we're back in the district court that had originally turned this down. And now the court takes a look based on what the Court of Appeals said. They take a look at how this situation should be handled. And unfortunately for the AICPA, it doesn't turn out well for them. What the court decided was that, okay, there is standing to challenge if it truly, if in fact this new regulation has an adverse impact on competition based on essentially the structure of the provision under which the AICPA raised the challenge. But the court said in this case that based on a Supreme Court case recently, that it has to fall within a zone of injury. And what they determined was that the provision under which the IRS issued this was one that Congress had enacted for consumer protection purposes. They decided that, in fact, what was happening here was that what the IRS was doing was totally consistent with the concept of protecting consumers, that they didn't add regulations on to CPAs because CPAs are already regulated. The AICPA tried to argue that, yeah, but we now have to basically supervise these unenrolled preparers. The court said, no, you really were already under the rules you operate under already. You have to have due professional care and you have to supervise these people. So there's nothing new here. So the district court found yet again that the AICPA did not have standing and dismissed the case once again. So now we're going to go back and see what happens. Not surprisingly, I would expect the AICPA to appeal yet again, and we'll see if the Court of Appeals now accepts what the district court says or if they send it back yet again, and we get to go through this one more time. In any event, stay tuned. But for now, the IRS appears to have the go-ahead to start running their program. Next up, the case of Copa Gaara versus Commissioner, Tax Court Summary Opinion 2016-35, issued on August the 2nd. This case involved an accountant who was working for a hotel near Los Angeles International Airport. At that time, to improve his position, he was a controller, he decided that he should get an MBA degree. So he signed up for an out-of-state MBA degree. In this case, he took an MBA degree from Brigham Young University and was actually traveling to and from Brigham Young. I guess one of the advantages of working near the major airport is at least you're close to the airport when you leave on, the afternoon when you go ahead and go out of town. But the bad news is you've got to go out of town. But he did. So he started picking up this MBA program, mainly online, but obviously somewhat going out of town for this. But the problem he had was following signing up and starting the program, he was laid off by the hotel. He continued the program while he was laid off, and he completed the program while he was laid off. During that time, he continued to look for a new job, but he didn't actually find one till after he had completed the program. The IRS challenged his deductions because he claimed a deduction for his travel expenses and for his cost of the MBA program. The IRS claimed twofold things. Number one, they claimed, well, wait, you were laid off. You don't have a trade or business. The tax court rejected that rule. They said, no, he had a trade or business. He continued to try to seek work. It's not as if he didn't have a trade or business. So IRS, you're wrong. The general rule is this can be an ordinary and necessary expense. But then the IRS went back to the other two issues. Even if it's ordinary and necessary, you still can't get a deduction for any education expenses as a trade or business expense if you fail to meet one of two criteria. or if you meet one of two criteria. The issue here is, did it meet the minimum educational requirements for a job, or did it qualify him for a new trade or business? Well, the IRS said, look, he got an MBA degree. This qualified him for a new trade or business. And in fact, he ends up getting a new job when he finishes this. So we think that, in fact, he shouldn't qualify for this. And, we believe no deductions allowed. Unfortunately for the IRS, fortunately for the taxpayer, the tax court didn't agree with that. The tax court found that, look, he had continued to look for a job. True, he didn't find one until it was done. But the new job he had was basically the same as the old one. The IRS didn't point out any way that this truly qualified him for a new position. So the tax court allowed the deduction. MBA cases are always kind of interesting when we talk about this with the tax court, because MBA cases, are always one of those issues where we see both wins and losses. General rule is you're not going to win this case if you end up not actually having been started a trade or business, have a true trade or business you're doing before you start. But if you do, most cases the tax court has found that an MBA degree doesn't really establish like a new trade or business opportunity in the same way that perhaps an accounting degree would, because you could sit for the CPA exam, or a law degree would, because you could sit for the bar exam. So because of that, the tax court generally allows it in those cases. This points out the other side. A taxpayer can end up losing his job. That doesn't kill the whole structure. Rather, in this case, the tax court found that the taxpayer still had his trade or business. Merely being temporarily unemployed does not cause you to lose a trade or business, even if currently you don't have one going on. For that reason, got the deduction. What this really comes down to is it's always a bit complicated deciding how education deductions are going to work for taxpayers. So you want to, make sure you take care and get all of the information together if your client is trying to claim deductions for something like an MBA degree. Make sure you get all of your facts together. Next up, the IRS throws in the towel. This is the case of Charles Sophie versus Commissioner and Bruce Voss versus Commissioner. This was a case originally decided in favor of the IRS, 138 TC number 8, decided back in 2012. It was reversed on appeal by the Ninth Circuit last year, AFTR 2nd, 2015-5128, last August 7th. Now, on August 1st of this year, the IRS issued its acquiescence on decision 2016-01. This case deals with the question of if you have an unmarried couple that jointly own a residence, is their limitation on deductible interest $1.1 million for the residence as a whole, or do they each get a take $1.1 million, allowing the unmarried couple to claim interest on up to $2.2 million of home mortgage interest or home mortgage debt? The tax court had ruled that no, it's a per residence amount. The Ninth Circuit Court of Appeals had ruled that no, in a split decision, 2-3 panel, a 2-1 panel, had ruled that in fact our limitation here was based on a per taxpayer amount, that was the better way to read it. Now, one thing to point out about this, which is obviously a key issue and troubled the judge in the minority position who upheld the IRS, it does mean that a married couple, nevertheless, is still stuck with having to reduce that. If you file marriage separate, the married couple has to reduce it down to half the limitation each. And if you file joint, you just get $1.1 million. So yet again, Congress has created a marriage penalty. Now, as the majority pointed out, that's not really an objection to the court holding that this is how you should do it, because as they point out, Congress has regularly created a whole bunch of, and we still have marriage penalties in the code. So the question quickly becomes kind of, well, who cares? We have a marriage penalty. Yeah, Congress put another one in. If they don't like it, Congress should go change the law. But for now, it does mean one of the consequences of getting married rather than quote unquote living in sin is that you're going to end up potentially losing half the home mortgage interest that otherwise was available to you. So again, Congress strikes again. Congress doesn't like married couples. And we have again discovered, at least for tax purposes, they don't like married couples. And Congress has again created a brand new marriage penalty. But if your client does qualify for this and you have somebody who you only claimed the 1.1 limitation on, remember there may be claims for refund now available because the IRS has now announced they are going to follow the Sophie and Voss decisions per the Ninth Circuit, and they're not going to claim the opposite. So if you have claims for refunds, be sure to get them filed. Next up, the case of Sisson versus Commissioner, Tax Court Memorandum Decision, 2016-143. In this case, we go back to something that we discovered many years ago. You may remember a number of years ago, Treasury Secretary Timothy Geithner, remember when he was coming up, former Treasury Secretary Geithner, when he was coming up for confirmation, we discovered that he hadn't paid self-employment tax on his IMF earnings. Now, he hadn't paid them because he was an employee and he'd used TurboTax to fill in his taxes. And TurboTax didn't stop and ask somebody, are you an IMF employee? Employees of many of international organizations end up still being treated as not employees for self-employment tax purposes. This was the case in Sisson, and our problem with Sisson is not that he didn't pay the tax. Well, he didn't pay it in this case, but not for the same reason as former Treasury Secretary Geithner. Rather, he didn't pay it because he thought he had filed personal bankruptcy. He had filed bankruptcy under Chapter 11. The Bankruptcy Code and the Internal Revenue Code generally provides that under section, in this case, 1398, provides generally that the tax computed on taxable income that's assigned to the bankruptcy estate should be paid by the bankruptcy estate. Mr. Sisson, noting that point, decided that, he did not include self-employment tax and self-employment income on his personal return because all that income was being reported by the bankruptcy estate. The IRS, however, said no, that just says on taxable income. And the tax court agreed. The limitation at 1398 merely assigns the tax on taxable income. In this case, the problem you face is this particular tax is not on taxable income. This tax is on self-employment income. The court held that 1398 did not say that any tax other than the tax on regular taxable income would be paid by the bankruptcy estate. As such, the court found that Mr. Sisson personally was liable for the self-employment income, and it was not the bankruptcy estate that had to pay that. Obviously, that makes a significant difference to him, whether it has to come out of his non-bankruptcy assets or comes out of his bankruptcy assets. Potential problem for Mr. Sisson, potential problem for your clients if they actually do continue to have a profitable business, but end up filing Chapter 11 bankruptcy. This case was a little unique because of the IMF side of the equation. But it is an interesting aside, and if you do have that fact pattern, your client needs to be aware, apparently per the tax court, that the self-employment tax is still going to be due and payable by them, even though the bankruptcy estate covers the income tax. Next up, the IRS, coming back to us many years later, has decided, about 17 years later, to take the tax court up on an invitation it made in its opinion in the Kerr case. We have proposed regulations under Section 2704 that attempt to bring back this provision from the ashes, just like the phoenix bird arose from the ashes to come to life. Now the IRS is going to try to bring back Section 2704. Section 2704 was part of the Chapter 14 provisions added by the Congress in 1990. It was Congress's generally not very effective attempt to attempt to get rid of discount planning in estate planning. 2704 provides that if certain liquidation restrictions, certain liquidation rights lapse at death or lapse on a gift, we're still going to consider the gift as if effectively the value of that property still included those rights that don't exist once it transfers over. And that's kind of a very rough way of explaining 2704. Now, in the Kerr case, the tax court had ruled on a number of bases that the rights in question didn't qualify for 2704 inclusion. They held that the question here was, could an individual partner have their interest redeemed? They said, well, that's not really a liquidation right the way we read it. Secondly, they had a they had a minor interest given to a charity as a partner. They said, well, 2704 only applies if the family can remove the right or add the right back in, can remove the restriction. And they said, well, the family acting unilaterally could not because the charity would have had to agree. And so the tax court said, hey, we don't think 2704 applies, so major discounts were allowed in Kerr. Now the IRS is coming back, and finally, at the very end of the Kerr decision, just before they get to the conclusion section, the tax court notes that the IRS is given broad authority to write regulations in this area, and if the service does so, then fine. But the regulations as written, the court said, demanded Kerr. Apparently it took 17 years, but the service has now decided, hey guys, maybe we should take the court up. My guess is what's happened shortly after Kerr, we had the cases in Strange where the IRS discovered how well 2036A worked. Now people are beginning to finally have learned that 2036A means that you better dot your I's, cross your T's, follow the documents. Now the IRS probably is finding it's tougher, and we're dealing with larger estates where it's more likely they're going to pay somebody who's going to really keep track of things and make sure the I's are dotted and T's are crossed. So now the service has decided maybe we need to go back to 2704 and try to get something that works on the document itself. And that's exactly what we're going for here. In this proposed regulation, and the good news for right now is it's proposed, but the bad news is this is estate planning. So the problem is the effective date of this says any restriction created after the law was passed in 1990, where the actual, lapse of the restrictions, the lapse of the right takes place after the date these regs become final will count. Well, that means if you already have your estate plan in place and you were counting on something happening at the decedent's death that now will be viewed as a lapse of a right, now the problem is going to be that will be taxable in the estate, and this may complicate your currently existing plans. The new regulation is going to impose a 3-year rule for what used to be an escape hatch. Under the old rules, effectively, let's say that you had a provision in your agreement where a majority of, holders of a majority interest of the partnership could vote to liquidate. And the, dad had 70% of the partnership. If dad gives he gives 21% now of his partnership interest to his children, dad no longer will have a majority. Well, under the old 2704 regs, that sort of a loss of a power didn't impact things because we didn't really remove the power from any interest. It was just by the nature of the structure that dad no longer could create a majority vote by himself. Now the regulation provides if you have a situation like that used to be grandfathered in, the taxpayer has to live 3 years after that transaction in order for that not to count and come back in the estate. So we're going to impose another special 3-year rule. So that's a problem. It also imposes tests for unrelated partners. In essence, they have to have certain special rights, certain minimum interest, and certain tests. So in essence, what was used in Kerr wouldn't work. Also, there are going to be special restrictions. No longer will it be good enough to have a state law right. Under the old regulations, the one we have now, if your restrictions are, if you're no more restrictive than state law is, then basically you're allowed to have the restrictions. And what happened was a lot of states passed special rules that said if you had a partnership that otherwise would be subject to 2704, then the following special rules would apply. Now the IRS says in the regulations, if there is such provision in state law, we're going to count that as an applicable restriction, and that lapse of right is going to bring in 2704. So that also will eliminate some of the planning that state legislatures had been basically brought in to do for these purposes. Now, remember, one key thing to keep track of here, right now it is a proposed regulation only. The real issue here is, though, it can have a very big effect on currently existing plans. So you want to make sure that you keep your eye on this thing, and if you're currently adopting a new plan, you might want to take a look at how it could be impacted by these. Finally, we have a new rule. The IRS decided they had to do something with the new partnership exam rules that were passed as part of last year's bipartisan budget agreement. These rules that take out the TEFRA rules, they're not mandatorily effective till tax years beginning after January 1st, 2018, but you can opt into them for earlier years. Now, that creates a problem because for most elections under these rules, when they go into place, you have to make the elections with the return. But the service discovered that, you know what? Nowhere in this rule did it say that this election to opt in had to be made with the return. The IRS had discretion. What the service has tried to do, decided to do here is they're going to push it back so that you only decide, I want to use the BBA rules once an exam starts, which means we're probably a couple years down the line before the first partnership will have to make this decision. And that gives the IRS a couple of years to get regulations and Congress a couple of years to patch the law before we have to worry about this. So effectively, that also means that the unfortunate side effect is we don't really know what the service is thinking of doing otherwise with these rules, because had they forced us to choose now, they would have also forced themselves to come up with an answer. One thing they did make clear here, though, if you read the rules, it's like, well, some partnerships will qualify to get out of BBA and go back to the pre-TEFRA rules that couldn't qualify under TEFRA. You could only have 10 partners under the TEFRA rules to qualify to go back to the pre-TEFRA partnership examination rules that weren't centralized. Now you could have up to 100 K1s and still qualify to go back if you don't have a disqualified partner, which, by the way, is the tough part about this, not getting a disqualified partner. The IRS made very clear you cannot opt in to the exam routines and then opt out of TEFRA. The IRS makes clear that if you're covered by TEFRA now and you decide to opt in, they're not going to allow you then to, right after you do that, opt out of the BBA rules and go to pre-TEFRA. Rather, tough luck. Once you opt in, you'll be under a BBA exam. If you make this election, the service made clear that you will get a notice that they will, within 30 days after you give them the election, they will then, as soon as practical, issue you a notice. I love it. They'll say, we'll do this as rapidly as practical, but then they say, but it won't be any shorter than 30 days after the election. So I guess practical for the service is 30 days. You also can only elect in for an administrative adjustment request made on or after January 1st of 2018. You also will not be able, if you're going to file an AAR after January 1st, 2018 for a pre-18 year, you're not going to be able to opt in if you have previously amended the return for that year or you previously filed an administrative adjustment request under TEFRA. If you've done either one of those, you have to stay under the old law rules. Again, the big thing here is it's going to give the service some time to publish the new rules. Keep your eyes open for those new rules because those are what can be really interesting. But it probably means we're not going to see those rules, my guess is, until maybe the end of next year or even the early part of the following year. Be the first time we'll probably see the service tell us a whole lot about what they expect to do with partnership exams under these rules. Now, it's getting into August, and you know, lots of things are happening. That's why we can record this every week in tax, and keeping up's hard. So remember, your state society offers live CPE courses that can help you keep current with the flood of new developments. You want to make sure you check your state society's websites for the courses in the areas you regularly work in, just to make sure you don't fall behind. We have brand new things happening in tax. We have lots happening in auditing and accounting. You know, we've got, if you have not done so, you should be planning for the new revenue recognition standard, the new lease standard. Yes, they're a little ways out, but you know you got to get clients ready. You've got to start talking with clients about how this is going to work. So take a look at your state society website and consider getting those courses. This has been the current federal tax developments for the week of August the 8th. Make sure you catch our updates during the week on our website at currentfederaltaxdevelopments.com. If you go there, you can also download a PDF with articles for all the topics we talked about this week. You can follow me on Twitter at edzollers.com. And if you have any questions or comments that you want to bring up, you can send those to me via email at edzollers@currentfederaltaxdevelopments.com, and I'll try to get back with them. Be sure to join us next week as we start looking for the brand new developments to take place in the coming weeks, in the coming week, I should say, in the area of federal taxes.